strategies that you're trading, that's going to give you a much more consistent and a much more consistent income stream using these types of strategies. So, and like I said, my personal preferences when it comes to cover calls is to be more conservative because that's what our research, over 20 years of back testing shows will outperform in the long run because of that capital appreciation that you get with selling cover calls. And one thing that I do want to show everyone here that I glanced over before is that if you go back to new opportunities, one real quick, all of the opportunities that are presented to you on the screen, as KV was showing you, is sorted based on annualized yield. So basically what we're doing is we're taking all 21 holdings of your portfolio and we are looking for that 45-day conservative cover call, and we're sorting it for you based on which of the opportunities have the most yield. And that's what you're going to see at the very top of the list. As you scroll down that list, what you're going to find is going from the highest yield to the lowest yield. So GameStop is not surprising, it's going to generate the most yield because it's the most volatile stock. Marathon Digital, also a very volatile stock, generates a fair amount of yield. And basically, as you scroll down, you have less yield because that's what we're sorting this criteria by. You can also sort it based on stock price. You can sort it based on different criteria that are important to you. But I generally think that when you're looking at income, yield, or how much income you're going to collect is generally going to be the more important metric to sort your list by. You don't have to take all the opportunities that are presented to you. You might take, only maybe the top 10, but that's really kind of where it's up to you. But you don't have to pull up options chains one by one, looking through all 25 stocks to figure out where you're going to get the most yield. This basically automates it for you and just ranks it so that you see the best yielding opportunities at the top of your list.
Excellent, Tony. And if you have some open positions, there's a special tab for it, right? So you guys are looking at some suggestions on what might be necessary or appropriate given the situation or circumstance that we're currently in. There are some open positions in this particular account, close to 15 of them. So let's go through one of them. I mean, if we want to focus on, hey, how about Baba over here? So what were the details of this Baba trade? Well, it was an August 16th 75 strike call that we sold. Probability expiring out of the money, an upcoming earnings date. So it's giving us some information that is vitally important, right, to be keeping in mind. So instead of going out there and scavenging through the options chain or the company's investor relations page to figure out when their earnings date is coming up, right? Or something of that sort. Everything is streamlined into one spot here. Talk to us about what you guys suggest on the close strategy versus roll strategy and the functionality there.
Yeah, so the close strategy is obviously if, in this particular case, we sold the August 16th $75 cover call. The stock is now trading above that at 79.20. So this is a cover call that's in the money right now. Now, from my perspective, this still has plenty of time left to go, 79 days to expiration. So because of that one factor, you don't have to do anything, which is why we have not presented, as you can see with the symbol next to it in Uber, you have that yellow sign that says total gain is greater than 80%. That's us telling you that there's perhaps an action that you can take immediately. So in Baba right now, because you don't have that yellow sign, it means that this is one that you probably should hold on to for now. With 79 days left to go, a lot can happen in those 79 days. The stock can go back below the $75 strike price that you've sold. So in this particular case, we're suggesting that you simply hold tight. But if you choose to either close out this call because you think Baba can continue to roll high, can continue to move higher, you can simply close out this trade at the current midpoint of the strategy, or you can click on that roll strategy, which will basically find an opportunity to roll this cover call to a later date or a different strike price, so that you can collect more premium and kind of recenter your cover call to a out of the money cover call. So I think Uber
Tony,
is probably.
yeah,
Go
Uber is
ahead.
a better example. Let's go ahead and look at that. So the idea that you've made already over 80% of the premium, and it still has got some time to go, but maybe a good spot for us to to do something about what we're dealing with at the moment, right? So that
Yeah.
idea, and of course this is a test account, so maybe some of the data is a little wonky, but the point is that there are signs and lights that are going up that are alluding to the fact that maybe there's something that you should be doing.
Yeah, that's exactly right. So here's an example where we've sold the August 16th $85 cover calls. The probability of expiring worthless is now 92%, so very high probability with 79 days left to go. You've already made more than 80% of the total potential premium of this cover call. This is a prime example of you certainly can hold this to expiration and try to collect the other, maybe 15, 20 cents that's left in this cover call. But there's not a lot of premium left, even if you hold it to expiration. This is a prime example of where you should look at rolling the cover call, basically locking in the profits that you've already made on this cover call and recentering again and selling a new cover call, collecting more premium. This is what we call selling, hitting doubles, when it comes to selling cover calls. I will say a lot of times when you find yourself in this position, where you've made a lot of the premium on the cover call upfront, it does mean that the stock has declined in value as a result of that. So this is something that we have to be aware of, because the last thing you want to do is continue to hold on to a stock and keep selling cover calls on a stock that's continuing to decline. So I always tell investors, if you find yourself in this position, think about evaluating whether or not this is a stock that you still want to hold. Maybe look at the chart, look at the technical analysis. You can see the stock is continuing to trend lower. If you think it's going to continue trending lower, cover calls are not going to provide enough income to offset the decline in the underlying stock. So keep that in mind. You're going to collect some income, but that income is not enough to hedge your position. So a lot of times you have to ask yourself, is this a stock that I still want to hold? Do I still believe in the bullish thesis of this underlying security? Ask yourself that question first. If you still believe in it, then yes, you can continue to sell covered calls. Otherwise, I advocate, you might want to close out your stock position as well and maybe reallocate that cash to something else. And that's kind of where we would bring ourselves to the cash secured put side of things, because that's where you can sell puts to acquire a new stock that you perhaps have a better outlook on than a stock that's no longer performing in your portfolio.
So Tony, that's perfect. I mean, I think a perfect segue to say, okay, we've talked about covered calls. Let's go ahead and cover short puts here as well. So let's say that you are getting rid of the stock and you are covering that call. Now you end up with some cash in your account and you're wondering, hey, maybe I should be evaluating a brand new position going forward. Could we entertain a short put strategy? So let's go through this. And a lot of the drop downs are going to be very familiar to you that we just went through. What are we dealing with here from the perspective of brand new ideas? We're looking at the watch list that we have created, correct, Tony?
Yeah, that's exactly right. So the rest of the opportunities or the strategies will be driven off of any watch list that you have created. The cover calls will be driven off of your holdings, because that's a strategy that you can only sell calls against stocks that you own. But all the other strategies are driven off of your watch list. So whether you've ran a screener and you threw those names in a watch list, or you've built your own watch list, this basically allows you to screen for option strategies across your entire watch list at once. Today, we're just going to focus on cash secured puts and cover calls, but you can apply this to all the other strategies. If you want to buy calls, do a debit spread, do a credit spread, you can do all of that using the same experience. So KV, we just talked about selling cover calls, right? Which is by far the number one income generating strategy that clients will use. Cash secured puts, on the other hand, in my opinion, I call it the number one underutilized income strategy by most investors. It's a strategy that many investors don't think about when they want to acquire a stock that they own, that they want to own, because usually we just place a limit order to buy the stocks that we want to own. But Selling a cash secured put gives you the same obligation as placing a limit order. It's just that a cash secured put obligates you to buy at least 100 shares of that underlying stock, and the execution typically will only happen near expiration or at expiration, versus a limit order gets filled as soon as the stock hits your specific price. But you have the same obligations as a limit order when you sell a cash secured put. The difference is that you get paid premium to sell that cash secured put that you don't get with a limit order. And that premium that you collect will provide a discount on the stock purchase. So here's a list of stocks. I have, KV's got 15 stocks in this awesome stocks watch list. And what we're doing is we're looking at selling cash secured puts. Now, I like to go shorter dated when I'm selling cash secured puts because I like the opportunity to own the stock in a relatively short period of time. I usually don't want to wait 45 or 90 days to acquire that stock. So I usually like to go shorter dated. And then when it comes to assignment risk, this is because I want to own the stock. I'm willing to get more aggressive on my strike prices when I choose strike prices for selling cash secured puts. A lot of times I'm selling shorter dated, anywhere from 21 to 30 days out. I'm usually looking at the strike price just below the current price of the stock. So if we look at Dell Technologies, currently trading at 173, this stock has just continued to take off alongside NVIDIA as they kind of build the infrastructure for a lot of these AI companies that are utilizing AI data centers. So looking at, if let's say this is a stock that you want to acquire, but you don't want to buy the stock near its 10-year highs, here you can look at selling the June 21st 165 puts. So that's obligating yourself to buy the stock at 165 if the stock is below that price on June 21st. And here I'm going to collect, in this particular case, $8.85 per 100 shares of the stock, right? So this is a $173 stock. In this particular case, I need basically $165 minus the $8.85 in terms of capital in order to sell this cash secured put, which comes out to be about $15,615 per contract, right? That's be the cost to buy 100 shares. But think about it. Instead of costing you $16,500 to place a limit order, now you only cost you $15,615. That's a discount of $885 per 100 shares. What does that equate to? That equates to a discount factor in this particular case. If we go to so this is the obligation to purchase 100 shares at 156.15. That's 9.7% below the current price of the stock. And this particular case gives me, if you go to the annualized return number at the top, KV, this is a 5.67% discount that I'm effectively receiving on the stock purchase, right? So imagine if you can purchase the next stock that you want to own with a 5% discount, right? And imagine if you can replicate that across, your entire portfolio, what that would mean to your underlying portfolio if you were able to pick up most of the stocks that you own in your account with a discount. Now, you might not be able to do this across all the stocks in your portfolio because you may not have enough cash to buy 100 shares of every single stock. But for the stocks that you are able to afford 100 shares or that you're willing to buy 100 shares of, this is a great strategy to allow you to acquire those stocks at a discount. And what we're doing here is we're basically sorting all 15 stocks in your awesome stocks watch list based on where you're going to get the highest discount or the highest yield by selling that cash secured put. So Dell Technologies, again, not surprising that it's near the top of the list. Cloudflare also at the top of the list here as well. So here I'm generating $208 of income to sell the $72.50 put when the stock's trading at 74.70. So this is a put option that's about $2.50 out of the money. So that's about a 5% decline before the stock gets to that break-even price. And I'm getting in this particular case a little over, just under 3% of the stock's value in terms of a discount by selling this cash secured put rather than just placing a limit order at 72.50 to buy that stock. So it's all about collecting income. And if the stock doesn't reach that 72.50 short strike price by the expiration date, Imagine if you had placed a limit order and the limit order doesn't get filled, you have nothing to show for it. Here, I have $208 worth of income to show for it. If in 21 days, the stock is basically still trading at where it is right now, and it hasn't fulfilled my obligation to buy the stock at 72 and a half, I have $208 to show for it. That's an annualized yield of about 58%. That's a nice yield just to have my cash set aside to potentially buy the stock. And if I don't, I move on. I maybe sell another cash secured put if I still want to buy the stock. But maybe the stock has moved higher. I've missed my opportunity. Well, I just go back to this report, find new stocks that I'm willing to purchase, and look at selling more cash secured puts. And the whole goal here is to continuously create an income stream for your portfolio as you wait to acquire stocks that you want to buy. And then once you acquire those stocks, look at selling cover calls so that you can additionally generate yield as you hold on to that stock, waiting for it to appreciate in value. And this tool is basically designed to automate all of that for you, the entire life cycle, and is completely personalized to your individual settings as far as how far out you'd like to go in terms of days to expiration, what your risk tolerances are when it comes to selecting strike prices, and presents everything in terms of the metrics that you need to on your screen, sorts it for you, and then in a single click, you can execute that trade into your Fidelity brokerage account.
Tony, in the last 60 seconds that we have you here today, sir, very much appreciate you showing up and sharing your wisdom with us. Tell the audience a little more about what can people do to gain access to this particular tool and how much does it cost?
Yeah, so this tool is available for everyone who has a Fidelity account to try completely free of charge for 30 days. If you go to News and Research at the top of your screen, you go to Options, and under Options Strategies, once you go to News and Research and Options, you'll find a tab at the top called OptionsPlay Strategies, where if you have not already signed up, you can sign up for a free 30-day trial, no credit cards required. And after the first 30 days, if you choose to subscribe to this tool to help you automate your income strategies, it is just $34.99 a month for this tool. And as you can see, when you look at selling those cover calls, we show you exactly how much income you can generate across your entire portfolio. And we feel that $34.99 is a fair price to charge for the amount of value that we can generate, the amount of income that we can potentially generate on your portfolio. And you can see that during your 30-day trial, how much income you can generate, and you can decide whether or not that's worth the $35 a month for the tool.
Tony, that's very fair. I think as options traders, we have to remember that each penny to us means a dollar. And so effectively, what's $34.95? Well, that's 35 cents in an option contract, right? That's how much it would cost. So yeah, absolutely. 30 days, free trial. Give it a go. See if you like it, and of course, sign up. I'm sure that Tony is going to be happy about it. Tony, thank you so much for showing up. I know that you're doing a few additional events with Fidelity. In the last few seconds, tell us where people can find more about what you preach and what you do on a daily or weekly basis.
Yeah, KB, Jessica and I host a weekly show called In the Money every single Thursday at 2 p.m., which you can watch here on fidelity.com, as well as we will be doing a longer strategy session on June 5th and June 6th, specifically for the tools that I'm showing you here today. So please make sure you join us for those sessions.
Tony, I'll do my absolute best to share those signups with everyone in the audience today, but we appreciate having you, and we'll see you next time. But everyone else, if you want to stick around and ask some questions, please be in here. Stick around with me. I will gladly click on a few more buttons and show you how things work around here. Tony, take care of yourself.
Thank you so much, KB. Thank you, everyone, for your time this afternoon.
So folks, a few questions. Like Carl was saying, why did it take so long for the roll button to appear? And Carl, that was something that clearly I was wondering about as well. In the real world account, that's not going to be the case. This is a test account in the virtual environment. So the stuff around this environment sometimes is wonky. All right, so it looks like on the short put strategies, it's pretty quick. in the covered calls side or on the covered calls side was a little bit long-winded there, but it shouldn't take long at all, right? Not more than a few seconds in a real account, suggestive of effectively what the next potential strategy that you're going to be rolling to actually is. So let's see if we can find something um, in here that has a suggestion, right? So the details on Spotify, for example, this looks like a pretty profitable strategy already. So if I clicked on roll, does it take very long? Not very long, right? A few seconds, suggestive of closing of this June 280 put and rolling it to July, the July monthly, July 19th 290 put. And you're doing it obviously at a very nice credit here, $527.50. That's kind of how it works. Play around with spreads a little bit, Stuart says. Absolutely. Sir, we did host a session with Jessica a couple weeks ago. We looked at this stuff. Again, there were a few questions in the audience from participants who are asking why are some strategies available for some and not for others. That is going to be dependent on your account level. So tier of your options approval. If you have options tier 1, you obviously can do cash secured puts and covered calls. If you have tier 2, you could be a buyer of calls and puts and a seller of calls against stocks that you own and cash securing those, right? So everything you can do on a tier 1, plus buying calls and buying puts. And for tier 3, you're going to be able to do spreads, inclusive of index stuff, right? If you have the full level. So just be aware of your options approval that you can find under accounts and trade, account features, and then going to options under that particular account and seeing what you're approved for at the moment, right? Let's go ahead and how about this? Stuart, you tell me which spreads would you like me to take a look at? Like at the moment, the market is quite weak, we could say. So do you want to be opportunistic and do you want to be looking at um, bull put spreads? Do you feel like the stocks are bottoming out and you want to look for those opportunities that sound good to you? Or do you want to be more bearish neutral? You let me know. Bullish. Okay, bullish neutral. All right, so we'll look at bull put spreads, right? In that scenario. So instead of just doing an outright short put with cash securing the position, you're now again going to be using the tool in accordance with your watch list. And this is where building out the watch list is going to be important, right? Hey, create a watch list where maybe it's the exchange traded products that you're looking at. Maybe it's the sectors within the S&P 500. What are some of the top companies within each sector, right? Maybe creating a watch list that is correlating to the top 50 names in the S&P or the top 50 names in the NASDAQ 100. So expanding your horizons in terms of your watch list so you can bring this technology and evaluate, right, the information pretty darn quickly that are buried within those watch lists instead of you having to do all that work on your own. So let's take a look at how these things are different. First, of course, again, time frame, short, under 21 days approximately, medium 45 days approximately, long term, should we call it long term, intermediate term, maybe, right? 90 days or so. Directional risk, if we are deciding that it's a short put spread, a bull put spread, synonymous. These are kind of structured around the deltas usually and your directional bias and your delta exposure. So again, conservative is going to mean that it's going to be further out of the money. balanced, a little bit closer to at the money, and then the aggressive is the closest to at the money. And you're basically telling the tool how much it is that you're willing to risk. So let's say we're not, doing something crazy. We're not doing $30,000, but instead we're doing $1,500 worth of risk. And we're looking at that medium term. Let's take a look what the tool spits out here for us. Okay, so BABA trading at 79.17. The stock has been under substantial pressure. I think it topped out on around 91. And in the past week and a half, came in hot and heavy, right? Just sub 80 bucks at the moment. Pretty big down day. Technical analysis, looking at that tab, saying, okay, where can it have the potential support? So the tool is identifying support approximately just shy of where it's currently trading. It's identifying resistance above, since we're focusing on a bullish neutral strategy. What is it doing? It is selling the closer to the support line put. That's about $1.50 away. It's making it 5 points wide 4 times, right? Risking less than $1,000, $780. Again, evaluating all of that information pretty quickly. And then my main point to all of you is to say, all right, well, this tool kind of creates the idea, generates the idea. Do you have to stick with this idea particularly, or could you play around a little bit with the strikes, make them a little wider or a little tighter, right? Based on what you're seeing on the option chain through the prism of the trade ticket after? Absolutely you could. Okay. So again, a nice way to evaluate underlyings that you have been already eyeing, maybe to be bullish neutral on, right? I think these percentages, um, probabilities of profits, the percentage of annualized returns. There were a few questions about that, by the way, and I can hop back over to where we were there, the short puts. I personally, folks, I'm not a big fan of hanging my hat on the annualized return number, and I'll explain why. Like you certainly could evaluate it from the perspective of how much in the best case scenario am I looking to make, or am I standing to make in the best case scenario if the stock is above the short strike by the time of expiration or it goes higher. So you're evaluating that number relative to the amount it necessitates you to put aside, right? To put that trade on. But you can't really annualize the return, in my opinion, because in order for you to annualize that return, what are you saying? You're saying I'm going to be able to do the same exact trade every 23 days without fail for the next year, for 365 days. Is the stock going to be at the same price? Are the options going to be priced the same way? Absolutely not, right? Market conditions change all the time. So yes, it's nice to say, well, the annualized return number is kind of a gotcha number, in my opinion. Will you be able to do it over and over and over again? That's ludicrous, right? So focusing on the raw return, I think is the best way to go about it. And then just moving on, right? Upon the recognition of some part, or all of that return before you move on to the next trade. So Thomas was asking, is there a historical data on the win rate of these recommendations? Thomas, not to my knowledge. And so, look, we're just going to trust this thing and say it's because Tony and Jessica are telling us that they've done years and years and years of back testing on this thing. That's exactly how it's going to play out. You don't have to go about it that way. I mean, in these 30 days, what would be my suggestion that you do? The free trial 30 days that you have, what can you do? You can go in here, evaluate the trades for the risk tolerance and probabilities of assignments based on what they are, build these trades out maybe in the simulator, in the profit and loss calculator on Active Trader Pro, and watch them play out, right? Evaluate them for what they are through this time cycle that you have to see how these transactions work. If you don't have any experience in the options trading world, you take an idea, whether it's OptionsPlay's idea or CNBC professional's idea or somebody else's idea, you make it your own. Eyes on the tape give you a substantial amount of experience. You don't have to jump in there head first with real money. You can build it out in the P&L and kind of watch it work, right? Mark is asking, is there any way to paper trade this particular software? So Mark, not this software, but you can take the idea, and again, like I said, hop over to Active Trader Pro. Let me just show you what I mean. So let's focus on this Dell. What is it? Short put in June, 165 strikes. So I'm going to hop over to my Active Trader Pro. I had it open since my volatility primer session here. We're going to go into the profit and loss calculator. We're going to type in Dell. And I'm just going to simulate this trade in here. So I'm selling to open one contract of the June 21st, 165 strike put. Hit it at the midpoint price of 835. Maybe we have a nice friend that works at Citadel that fixes us up right at the midpoint price. Here you go, right? So this particular strategy is in your account as a simulated trade until it either expires or you right click and delete it, or you edit it, right? Each day that passes, you're going to see a realized P&L or a theoretical unrealized P&L in accordance with whatever happens to the bid offer. So let's say that I'm evaluating this thing and, maybe Dell goes to, 178 and that happens by the end of the week. And maybe implied volatility comes down 2%. And now I'm going a little bit advanced for everybody. But what is this option going to be worth if these things were to play out exactly to a T? Well, I'd be looking at around a 1/4 of a profit, $215 worth of a profit, if the stock just rallied another $4 in a couple of days and implied volatility shrank slightly. So you have the capacity to use the simulator evaluated, right, for hypothetical scenarios, but it also will always evaluate it from the current bid ask and the real relative theoretical P&L to whenever you evaluated the strategy for originally. Okay. Let's hop back over to fidelity.com here. You, ladies and gentlemen, are not going to be asking me a whole lot of questions. I'm going to run out of things to talk about. I certainly am not the salesperson for this particular tool, and just showing you how things operate. Naturally, like I mentioned, I mean, it's $35 a lot of money per annum? Well, it kind of depends on how you think about it, right? Let's say that you're involved 10 months out of a year. That's $350, right? $350 per annum. Like two months of the year, you're maybe off, you're on vacation, you're enjoying time with your family. So $350. How many trades will it take for me to pay for this thing without losing my shirt, right? Well, hopefully you're putting on trades because they match your time frame, your risk parameter and assessment. And hopefully you're choosing something like a short put or a short put spread because you are truly bullish, neutral, and underlying. You're not just saying, well, I think Dell is going to 150 between now and a week from now. So, I'm going to go ahead and do a short put. That's nonsense, right? Like if you thought it was going to 150, if you think it ran too much from you know, 125 to 175 in a very short term, this might be a no touch for you from the perspective of a neutral bullish strategy. So you still have to evaluate the strategy for what it is and make it your own. You understand the assignment risk probabilities and the yields associated with them. But at the end of the day, what's 350 bucks? Well, it's $3.50 worth of premium for one contract, essentially, right? That's all it is. That pays for a year worth of a subscription to this tool that allows you to evaluate everything you got and then some pretty darn quickly. $350 doesn't grow on trees, that's for sure. But Sony is saying they're offering this tool at $750 a year on their site. Well, there you go. That's a, you know, great discount to what their site offers, at least for the moment. So anyways, you're asking if they're recommending any butterflies or other strategies, right? So not at the moment. I mean, they started with covered calls and short puts. They've clearly expanded the you know, the features into spreads. Um, you know, if I have to be honest with you, here's my honest answer. If you are a butterfly and iron condor trader, you're likely not using this tool to help you evaluate what you need to evaluate because you know what you're looking for, right? Like if you're a butterfly and a condor trader, you're trading vol, so you're looking for high implied volatility ranked underlyings, right? Or low implied volatility ranked underlyings. Like you're trading direction indifferent um but volatility bias strategies. And that's not a beginner thing to do, right? Not at all, in fact. So I don't know if they ever will build it out. Maybe they will, but clearly not at the moment. They're focusing on just the beginner to maybe intermediate clientele base. And I think even if you are intermediate or if you are advanced and you are signed up for this, I think it's still a very nice way to kind of evaluate what you got going on already, right? From these strategies alone and that standpoint of view. Like, hey, I'm you know, I'm already squeezed out more than 80% of a particular short put that I sold over here. Hey, that's a really nice reminder for me. How much more could I make? Oh, I can make 5 more cents. That equates to $5. How much capital do I have committed to this trade? 2,500 bucks. Does that make sense for me to keep $2,500 tied to a strategy where the maximum additional money I can make is five? Not at all, right? Clearly roll the darn thing, close it or roll it. So sometimes if you have a lot going on in your account, you're just not really paying attention to the capital efficiency of that money that is tied up. And I think tools like this could bring that to the forefront, even if you're not using them directly as prescribed. Yeah, there you go, Serena. So I am not familiar with like the remainder of the offering that they have on their website. Could they do iron flies or iron condors off of some of the tools that they have on their website at the moment? Certainly it's plausible, right? For sure. Without a doubt. Like I mentioned, my answer to you about that was I am a butterfly and a condor trader. Um, would I go out right to an OptionsPlay tool to kind of look for those opportunities? No. I mean I would build out, you know, I would be spending the vast majority of my time really playing around and tweaking the options screener tool, which I do quite often for participants in the volatility primer, right? We're looking for high IVR, low IVR, liquid securities that have a lot of open interest, that have a lot of volume, that are trading unusual volume, um, on that day, right? Like trading 150 to 200% of ADV through the first couple hours of the morning or something like that. Like, where's the action? Um, so I would be spending a lot more time in there. And if you're interested in those types of tools, uh, keep joining the volatility primer that I run on Wednesdays. I oftentimes show how exactly I do that and the criteria that I use. Doesn't make them the best, doesn't make them the greatest or absolute, but I certainly share with all of the attendees the way I usually approach markets for sure, without holding anything back. Carl is asking if there is a guide available for options play. Carl, there isn't a guide. There is a key terms list here, top right-hand side corner. So if any of the stuff is not making sense, like line items wise, it is all explained here, in plain English. So I think that's probably a good starting point. So if you are just starting to click around, you're on covered calls and you're looking at all the individual line items and one or two of them do not make sense, keep that key terms condition top of mind. I think that would be the best way to go about it. Russell, absolutely. So for the short puts, you can definitely create a watch list with all of your existing positions and, evaluate like, hey, these are my existing positions in a brokerage account. Could I do some additional short puts on the stuff that I already own, right? Long. Absolutely. Someone asked me earlier if if they look at a covered strangle, for example, or a covered straddle, probably a little too advanced for the novices in the room. But I mean, really, what are we talking about, right? What is a covered straddle or a covered strangle? A covered straddle is when you are long a stock and short a straddle approximately around where the stock is trading. So you're short a put and short a call. So what are you really? You're short a put and you're at the money, which is pretty aggressive, and you have an at the money covered call written against the stock. That's a covered straddle, right? A covered strangle would be where your short strikes that are further out around where the stock is currently trading, right? I mean, those are neutral bullish strategies. Now, could you be creating a neutral bearish strategy, being short the stock and doing the opposite? Of course you could. Being long the legs and short the stock, absolutely. But again, a little bit more nuanced, more complex. I don't want to confuse anyone or freak anyone out. These things, by the way, if you're unfamiliar, like what would I do if I was trying to learn about this stuff a little bit more? Just type in straddle into search or get a quote, top right-hand side corner, and let's see if this test account is actually going to allow me to access. It does. All right, that's good. So short straddle, long straddle, straddling the market for opportunities, and then a cover straddle, the one that I just described. Long stock, short at the money call, short at the money put. So clicking on those things and going into the guide, and then from there, kind of building things out, right? Building your knowledge out, not being afraid of these things, going into the profit and loss calculator and recreating the strategy around the stock that you're thinking about to look at the profit and loss diagram, so forth, so on. Will the membership allow the access to their website? Julio, I don't believe so. Um, this is just a fidelity deal, right? So there's no like special login into their website. It's just their technology built into Fidelity.com's website at the moment. Do we have access to the test account or is it only for instructors? Greg, we do not. So this is only for me at the moment. And it's a completely hypothetical portfolio. It's not real dollars. Um, so it's kind of in the in the World Wide Web, right? So, no ability to share it with clients, unfortunately, at this moment. But it even logged me out. It's thinking it's time for you to get kicked out anyway, sir. So kick me out of the test account. Maybe somebody else logged in. No recording for the event, but again, bear me just a moment. I'm going to share with you the upcoming events. Let me go to the normal website here on fidelity.com. All right, let me share this with you folks. So they do have a couple of events coming up. If you go to news and research, you go to learn. No recording of this particular session. Unfortunately, as you know, if you've been attending coaching sessions in the past, none of the coaching sessions are recorded. They're recorded for compliance purposes to make sure I don't drive off the reservation, right? For the compliance people to make sure that I'm in line. But the recordings are not posted anywhere. If you are looking for more of a recorded event or that has the potential of being recorded, you go to events here on the left, you click on upcoming events, and then you look for something that has OptionsPlay in the name. So in the money, that's what Tony talked about. I frequently host that one for them. Let's take a look. Generating potential income using options. That's an OptionsPlay event for sure. So the 5th of June, be on the lookout for that one. And then exploring long options and option spreads on June 6th. So sort of back to back, 2 p.m., the 5th and the 6th. And you can sign up for these events. These are still on the nose. And maybe they will be recorded and posted into the archives in the future, but I cannot guarantee that, unfortunately, folks. I may was asking is in general a straddle used for earning credit, like an iron condor is used for, or is not the case. Um, a straddle, remember, is the same strike price. So a straddle is basically the guts of a butterfly, right? A strangle is the guts of an iron condor. So, is it used for earning credit? It could be if you are a seller of a straddle. So what are you doing if you're a seller of a straddle? You're selling a put and selling a call to save strike. You are, as I mentioned earlier, a volatility trader in that sense. You are direction indifferent. You're basically saying, I don't care which way the security goes. I just don't think it's going to move to the left or the right by more than the credit that I'm bringing in. So you're basically saying the options and the expected movement that they're currently pricing in your view, it's too big of a move. And you think the stock is going to be within a range, inside of that range. The tighter the range, the closer to the at the money or the strike that you are a seller of, the better, in order for you to keep all of that credit. If you're a buyer of that straddle, right, you're betting on the exact opposite. You're saying options are way underpriced at the moment. I don't care which way the market goes, north or south, as long as it moves by more than what I'm paying for it. All right, everybody, we'll wrap it up here. It was a great pleasure to see you. Again, appreciate you joining us. Too bad that Tony only had half an hour, but hopefully I answered a few additional questions that kind of rolled through. More questions of intermediate nature and not a whole lot of them about the tool, which is totally fine because I don't think Tony would be too inclined to be answering these. All right, everybody. We'll see you soon. Best of luck in the meantime, all right? Tomorrow on the day after, still a couple of big days on the nose, folks. GDP, second look at the GDP tomorrow morning, pre-market. Better or worse than expected, remembering that the first look at the GDP in the last couple of weeks was not the greatest. It definitely came in substantially lighter than expectations. There was some nuance there. behind the data, but we'll see, right? Is it getting revised down or up? And then on Friday, we have the personal consumption expenditures, which is the exact thing that the Fed looks at for their view at super core CPI, right? So two big macro events. We probably get a few additional speakers from the Fed through the remainder of the week. But then next week, they are no longer going to be speaking. They go into the quiet window because then we're in the lead up to the June Federal Open Market Committee session. So that's the reason why they were all on parade, right? Kind of highlighting their views over the past 2 weeks, in some cases several times a day. My head is spinning. I can't even pay attention to who said what and when. But we're going into the quiet period, which for me personally, I admire that period. If you ask me, I love it. Less from them to confuse the market a little bit less or jawbone the market less. The market has the ability to figure out what it wants to do on its own. I prefer that a whole heck of a lot more than somebody else affecting the price action on a daily basis. I would rather price do what it wants to do and my having the ability to react to that price action without jawboning. All right, everybody, we'll wrap it up here. Take care. We'll see you soon.